In this video, we will see about the structure of securities market. To put it simply, the securities market is the place where financial instruments are issued, bought by investors, and then transferred between them. You can think of this market as having two distinct but inseparable parts. On one side, we have the primary market, also called the new issue market, where issuers raise capital by creating fresh securities. On the other side, we have the secondary market, which facilitates trades in securities that have already been issued. As we go through this video, you will see how these two depend on each other to enable liquidity and the creation of financial assets. Let us start by looking closer at the primary market, which companies use to raise fresh capital from investors. Now, a company known as the issuer has two main ways to do this. They can either make a public offering where they sell securities to the general public, or they can choose a private placement where they offer shares only to a select group of investors. Within a public issue, the shares can take two forms. They can be a fresh issue, which are brand new shares created by the company, or an offer for sale, where existing large investors or promoters sell a portion of their own holdings to the public. One of the most popular terms you will hear is the IPO, or initial public offer. This happens when a company sells its common shares to the public for the very first time. The main goal here is usually to raise equity capital to help the business grow. However, a company cannot just wake up and decide to launch an IPO. They must meet eligibility criteria set by SEBI regarding their assets, profitability, and net worth. SEBI regulations also specify who gets these shares. In a standard eligible issue, at least 35% of the shares must be allocated to retail investors, which are people investing less than 2 lakh rupees. On the other hand, at most 50% can go to qualified institutional buyers, while the balance goes to other investors. Now, within those big institutional investors, there is a special category called the anchor investor. Think of them as a qualified institutional buyer who commits to investing a large amount, specifically an application value of 10 crore rupees or more. They are significant because they help build confidence in the market. To give them a head start, bidding for anchor investors opens one day before the public subscription begins. They can be allocated up to 60% of the portion reserved for institutions. Essentially, if you see strong interest from anchor investors, it serves as a good indicator of the quality of the offer. Moving on, what happens if a company is already listed on the stock exchange but needs to raise money again? This is called a follow-on public offer, or FPO. Just like an IPO, this can involve issuing fresh shares to raise new capital for growth or to pay off debt. Alternatively, it can be an offer for sale where existing shareholders sell their stakes to the public. Sometimes companies issue an FPO simply to meet regulatory requirements regarding public shareholding norms. Now, let us switch gears and look at private placement. As the name suggests, this involves issuing a large quantity of shares to a select set of investors rather than the whole public. According to the Companies Act 2013, the golden rule here is that the number of investors cannot exceed 50. The benefit of this route is that the strict requirements for a public issue do not apply here. A company can use this method regardless of whether they have done a public offer before, and the shares can still be listed if they meet the requirements. There are two main types of private placement we need to understand: qualified institutional placements and preferential allotment. The first type is the qualified institutional placement, commonly known as a QIP. This is a private placement method used specifically by listed companies. Here, the company issues shares to identified experts known as qualified institutional buyers, or QIBs. This group includes large financial institutions, mutual funds, and banks. While it is private, the company still has to follow SEBI guidelines regarding the quantum of the issue and the pricing terms. The second type is a preferential issue. This happens when a listed issuer offers specified securities to a select person or a group of persons on a private placement basis. It is important to note that this is distinct from public issues, rights issues, or employee stock options. Even though it is private, the issuer must strictly comply with SEBI regulations and the Companies Act. This involves following rules about pricing, making proper disclosures in the notice, and adhering to lock-in periods where the investors cannot sell the shares immediately. Sometimes, a company wants to reward or raise funds specifically from its existing shareholders. This brings us to rights issues and bonus issues. In a rights issue, the company gives existing shareholders the right to buy more securities at a specific price based on a ratio fixed on the record date. As an investor, you can choose to exercise this right and pay capital to buy the shares, transfer your right to someone else, or simply let it lapse and do nothing. On the other hand, a bonus issue involves giving shares to existing shareholders for free without asking for any consideration. Here, the company takes money from its retained earnings and capitalizes it into share capital. We briefly mentioned the offer for sale earlier, but let us clarify it further. In an offer for sale or OFS, promoters or large investors sell their existing shares. Because no fresh shares are created, the company's share capital does not increase. The proceeds from the sale go to the offeror, such as the promoter, and not to the company itself. A common example is the disinvestment program, where the government sells its stake in public sector undertakings. We also need to consider the geography of where capital is raised. If capital is raised from the domestic market, it is an onshore offering, whereas if it is raised from investors outside the country, it is called an offshore offering. Companies also use shares to motivate the people who work for them to align their interests with the company. One way is through sweat equity. Under Section 54 of the Companies Act 2013, these shares are issued to employees, promoters, or technocrats as a reward for their contribution. This involves issuing new shares. Another popular method is the employee stock option scheme or ESOPs. This gives employees the option to buy shares at a predetermined price after a certain period, known as the vesting period, which is typically more than 1 year. The employee gains if the share price rises higher than the exercise price. Now that we have covered how securities are created, let us move to the secondary market. This is where the liquidity happens. Here, investors deal with other investors, and the company that issued the shares is not involved in the transaction. The secondary market is broadly divided into two segments. First, we have the over-the-counter market or OTC, where trades are directly negotiated and settled between two parties. Second, we have exchange traded markets, where trading happens through stock exchanges and a clearing corporation guarantees the settlement of the trades. When you buy or sell a share on an exchange, a specific process takes place involving 3 steps: trading, clearing, and settlement. It starts with trading, which is the formal contract to buy or sell using an electronic order matching system. Next comes clearing, which is the calculation phase, where the system ascertains exactly what buyers owe in money and what sellers owe in shares. Finally, we have settlement, where the obligations are settled by delivering shares and paying money. To make this safe, the clearing corporation performs a function called novation, meaning it acts as the buyer to every seller and the seller to every buyer. Because the clearing corporation guarantees settlement, it exposes itself to the risk that a buyer or seller might default. To manage this risk, they use a system of margins. Think of a margin as a safety buffer. The initial or upfront margin is a percentage of the transaction value collected based on the value at risk concept. Then there is the mark to market or MTM margin, which covers any notional losses that might occur due to daily price movements. Unlike the exchange traded markets, in OTC markets, the counterparties have to manage their own credit risk